you guys doing? I'm Kent Tilley. Welcome to the channel. Today I want to talk about 7 rules of thumb in finance. And I'm going to start with 2 that talk about a couple of investing rules of thumb. And then I'll talk about 2 that are sort of retirement and amounts that you're shooting for rules of thumb. And then lastly, I'll talk about a couple budgeting sort of techniques or rules of thumb that we sort of work on. These aren't necessarily ones that I use all the time, and I'll kind of talk about why I don't necessarily believe in some of them. But we'll just get started. With investing, one of my favorite rules of thumb is the rule of 72, which is just saying that your rate of return divided, or 72 divided by that amount, is how long approximately it's going to take your investment to double. So if you got a 1% rate of return, it's going to take you 72 years to double your money. 2%, 36 years. 7.2%, it's going to take you 10 years to double your money. So that's why you sort of start to see that compounding effect, is if you can get a high rate of return, it doubles, and then it doubles again, and then hopefully a third time by the time you retire, really starts to add up. There's another investing rule of thumb. This changed recently. It used to be a rule of 100. Now it's called the rule of 120. I mean, either can apply, but I think it makes a little bit more sense with the rule of 120. It's just suggesting how you should have your portfolio positioned based on your age. How much risk should you actually be taking based on your age? So it's saying 120 minus your age is the amount of equity that you should have in your portfolio. So if you're 20 years old, so 120 minus 20, it's saying you should have 100% equity in your portfolio, no fixed income. The reason for this is because over history, the equity market outperforms the fixed income market. You have so much time in the market that it doesn't really matter that you can ride out these waves. And as you age, you slowly start decreasing your risk. So if you're 60 years old, for example, 120 minus 60 means that you should have 60% equity in your portfolio. Now this obviously isn't going to work for everybody, because that's going to take them, under or above their risk tolerance. So just because we say that doesn't necessarily mean that that's what you should do, because if you're not comfortable seeing those ups and downs, and it's actually going to cause you to maybe pull out of the market when you see a correction or something, then you're going to want to have a reduced risk anyway. Now we'll get into a couple retirement rules of thumb. So people always ask, and I've talked about this on a couple other videos, how much money do I need to retire? One of the rules of thumb is called the 4% rule. And that is suggesting that you could take out 4% of what you have indexed to inflation for the remainder of your life, and most likely you will never run out of money. So for example, if you have $1 million, then you should, technically be able to take out $40,000 every single year indexed to inflation. No matter what really happens in the market, you should never actually run out of money. This is, sometimes this rule fails. It's not necessarily what you have to shoot for. And I'll kind of talk about that a little bit more in the next one. So another rule of thumb on how much you should have for retirement is 20 times your gross pay. That's what you're shooting for to have in a lump sum by the time that you retire. So for example, if you had a salary of $50,000, then it's suggesting that you're shooting for $1 million portfolio. $100,000, you're shooting for a portfolio of $2 million. To be honest, in my opinion, I think that these numbers are actually high, because if I start looking at incorporating CPP, maybe another pension, OAS, And the pension, I guess I shouldn't have brought up because, this is saying that that should be calculated sort of as a value. But most people's spending goes down quite significantly in retirement. So if you're saying you retire at 65 years old, you've got 20 times your gross income in a portfolio, you're going to live till 85 or 90. Well, just having it almost sit in cash and match inflation is going to make sure that it doesn't run out. And that's living off of that 100,000. But you're actually going to be probably spending less than you're making. Your bills are going to go down. You're also going to get those government benefits. So I personally think that in most cases, this number is quite high. Just my personal opinion. And as far as budgeting, so we'll talk about 3 rules. And this one is one that Chad's actually going to do a video on. This is something that he's actually incorporated into his daily life, so he can talk about it in more detail. But it's called the 50-30-20 rule. So what it's saying is after tax, when you take home your money, let's say, just for ease sake, because it's late at night and it's easier for me to do math, let's say you take home $10,000 a month after tax. Well, it's saying you're going to put 50% of that towards, what you need. So that's your house, that's your food, these are all your bills, your utilities, all of those things that you actually need to get by in a daily life. Then you're going to take 30% of that, so 3,000 of that 10,000, and you're going to spend that on things that you want to do, things that you want to buy. And then the remaining 20% is going to go towards debt repayment and investing. So that's the 50-30-20 rule in a nutshell. As far as emergency funds, when we talk about how much somebody should have saved in an emergency fund, generally speaking, we're looking at somewhere between 3 and 6 months of, your expenses or your take-home pay that you kind of want to have in an emergency fund. I know that's really hard to actually build up because it's not like you have that much in excess after you've paid all your bills and done all these things. It can take a long time to build up that emergency fund. In some cases, depending on your career, what things are, if you have a very stable job, maybe you're a teacher, well, maybe my wife doesn't need as big of an emergency fund because she knows that she's got, that set income that's coming in all the time. But if somebody that's working in, something like sales or something that can go up and down, or the oil and gas sector, you're probably going to want on the higher end, maybe even upwards of 9 months. And then lastly, people say, how much should we save for retirement? The very first financial book that I ever read when I was like 10 years old, my dad knew that I liked money, so he bought me The Wealthy Barber. And all that story is suggesting is that a barber who obviously, isn't a high income earner is wealthy because since the beginning of his career, he started taking 10% of his income and investing it in this case in the book, mutual funds that were like returning like 12% a year, because I think it was written in the 80s or something. So everybody was just dominating. But anyways, so it's just saying he's investing 10% of that money, and over time that's really, really going to add up. And it's almost as simple as that. It's like just taking that portion of your income and saving it, sort of diligently, investing it in good, solid portfolios. Hopefully you're, reducing your costs and staying patient with the market, matching your risk tolerance should really work out for you in the end. And as you age, obviously, as you're getting closer, if you've delayed, then you have to start saving more. So that number can sort of jump up near the 20% range. Or, if you're even older and have no savings, it might be higher. You might have to make some more significant changes as far as your retirement goals are concerned. So there you have it. There's 7 rules of thumb for money. Thank you guys very much for watching. If you haven't already, please subscribe. We're very happy to hear from you, and we love subscribers. Thank you very much for following the channel, and check back soon for another video.